We can get going, it's just approving the minutes.
Okay. All right, so it's called to order the meeting of the Finance Committee for August 19th, 2019. Roll call, please.
Vice Mayor Schaefer?
Here.
Vice Chairman Jones?
Here.
Chairman Hellinger?
Here. Next up is approval of the motion summary for the meeting held June 17th, 2019, as recorded and transcribed.
Move for approval. Second.
Roll?
Vice Mayor Schaefer?
Yes.
Vice Chairman Jones?
Yes.
Chairman Hellinger?
Yes. All right, moving on into the meat of the meeting. Review the annual financial statement, 2018 audit.
This year we have new auditor, so a little bit different approach. Here with us today is Megan Poth, CPA for Wilson, Shannon, and Snow. They'll be doing our audit for,
I would say this is the first of, the first.
is it 5 more?
First 5.
Or is it 3 or 5? I think it's 5.
We're
isn't
lucky
it?
got 5, yeah.
They had, Wilson, Shannon, Snow had previously done our audit for a number of years. The state auditor instituted a new policy of sorts, indicating that for public entities that have outside contracted auditors performing the audit on behalf of the state auditor, that at least once every 10 years that the state's going to come in and do the audit. But I think they did it 2 years here, didn't they? So they're a little bit more rigid in what they can do. They wanted this all to be an executive session and all those sort of things. So little less formal, I guess, with Wilson, Shannon, and Snow doing our audit. But they're very familiar. After the state did do the audit, we had to go out and take proposals. We ultimately don't get to decide. It's the state auditor that gets to decide who conducts the audit on their behalf, but we did have input into that process. And ultimately, there were multiple firms that were considered, and Wilson, Shannon, and Snow was the entity that's selected, and they'll be doing our audit for the next 5 years. Along those lines, today, just a good financial practice to have the results of our audit reviewed. Probably less the actual financial statements, unless you want to talk about those, but more so some of the items that were identified in the course of the audit. And I believe Megan will walk through those. You all know Rob Alger. He works in my office. He's a city's accountant. He handles a lot of the day-to-day activities with our financial statement preparation and interacting with the auditors on a more regular basis. So if there's any bad things that come up, ask Rob.
Oh,
Go ahead.
that's
Yeah,
it.
if you wanna go. Sure, I think it'll maybe pick it up better.
It'd be helpful if you said,
Okay.
introduce yourself, please.
As Dean mentioned, I'm Megan Poth from Wilson, Shannon, Snow. Is that okay? Right there? Okay. I'm just going to go over some of the key points of the audit. As Dean mentioned, we did the audit previously, and the auditor state took it back, and then we are now back doing the audit. And the other partner on the audit at the time was Jason Carr, so the two of us worked together to lead up the audit, and we were able to file timely. We filed by June 30th, and the audit has since been certified and released on by the Auditor State's office, so it is available on the Auditor State's website for the public. As you'll see, there was a management letter included with the report submission. That is not out on the Auditor State's website, but it is available upon request of the public.
Just real quick, just to refresh and just kind of give an idea maybe in advance of going through them what the reports are. And just, I know they kind of hear this once a year, but I'm sure it doesn't quite
Absolutely.
settle in.
Absolutely. The reports that are submitted to the Auditor State's office include the CAFR, which is also submitted to GFOA, which is your entire financial report, along with our opinion, which was a unmodified clean opinion once again for 2018. We also issue a single audit report because you expend more than $750,000 in federal award money. You have an additional single audit report requirement. And within that single audit report is also our report on the government auditing standards, which is also referred to as a yellow book audit, which basically is just the overall compliance report that all government entities receive, and that again had no, will refer to within the schedule of findings, will refer to the significant deficiency that was reported within the schedule of findings would be on that particular yellow book report. So we'll discuss that, but that's included as a separate report from the CAFR. So there's the CAFR, there's the single audit report, and then we also do the data collection submission, the data collection form submission through the Federal Clearinghouse, which is part of the single audit report requirement. I guess I will direct you to our post-audit conference packet here. On the, I guess the first page of the actual report that has our letterhead on it dealing with sort of an overall summary of the audit report process, or the auditing process. We initially start the process with an engagement letter that goes to Dean outlining this is what we're going to audit and our approach and the responsibilities of management and the responsibilities of us as auditors. Some of the key aspects for this particular 2018 audit were the adaptation of GASB number 75, which deals with the reporting of other post-employment benefits. This is very similar to a few years ago when there was the GASB 68 implementation dealing with pension liabilities. This now brings on the other piece, the other post-employment benefit liability. So the accounting for it was similar, the approach was similar to how we do the net pension liability reporting and disclosures. So if you look at your CAFR, in note 2 actually outlines what the dollar amount impact of the restatement of bringing on that GASB statement, and then you also have additional note disclosures and additional RSI schedules. So if you're comparing last year's CAFR to this year's CAFR, you'll see that those particular note disclosures have expanded, as well as the RSI schedules have expanded, and that will continue moving forward now. So that was the significant standard implementation that occurred during 18. That would have been something different from your prior audit. But other than that, all of the general accounting procedures and principles were consistent with prior year. Under difficulties encountered in performing the audit, there were no difficulties. Management was cooperative and provided us with all the information that we needed. Corrected and uncorrected misstatements, this will also refer back to the schedule of findings. We did note some audit adjustments. If you want to go ahead and skip ahead to, let's see, it's about the 4th page in. It has finding number 2018-001. This is the finding that would be referenced in that yellow book letter as well. It's not uncommon for there to be instances where audit adjustments are necessary, especially when situations don't occur every year. This was something that was the bond anticipation note issuance rolling over to bonds. The accounting for it on the GAAP side was not in accordance with, as you see, GASB statement number 62. So as a result of that, we had to propose an audit adjustment, and it impacted these different opinion units in these amounts. And if you go to the next page, there was also...
Before you jump into
sorry.
that, again, what she's referring to is basically changes to our financial statements. Big challenge is trying to stay technical with all the, she mentioned several, this GASB change and this pension recording, and sometimes these liabilities are, back in the day when I was in CPA, again, they were measurable and tangible, and I think sometimes the definitions of what constitutes a liability changes at times. But anyways, our typical process is we operate throughout the year on a cash basis, budgetary basis. At the end of the year, we then convert that to GAAP basis financial statements, accruals, and all kinds of other things. We prepare our financial statements, which are intended to reflect the financial condition of the city. Just like a private business, we have, a balance sheet, we have an income statement, showing the results of that given year. And we have a lot of note disclosures where we're emphasizing any number of different things, but how and where they show up in there is challenging to stay current on. We do contract out with, and we started 2 years ago, with Julian and Grube to assist, because these things are constantly changing. It's kind of like one of those quasi-governmental entities that their existence relies on the fact that they keep changing things. But anyways, so we try to do our dangest to stay current in what we actually include and how we report the information. Both of these two, they call them findings. In essence, what occurred is the auditors, they came in and looked at our financial statements. They found some reporting changes that needed to be made. The one on that page that was just referred to, what ultimately happened is, as you're well aware, we've been issuing short-term notes for the Glen Road project for probably going on 10 years. The economics of that made a whole lot of sense. Several years ago, they made a change because instead of those being reflected as short-term debt, the determination was made that in essence, because we've issued and reissued, it actually needs to be classified as long-term debt. So I got reclassified on our financial statement. It didn't change how much we owed or what we were doing, but just where it showed up on the financial statements. This year, we did this financial statements are as of December 31st, and we start our conversion process in the early part of the year. Well, those notes actually got converted in April. We issued bonds for that Glen Road debt. It's kind of a post financial statement date issue, but because of that, we needed to account for how that debt was reflected on our books. Again, it didn't change how much debt or how we paid it back or what we did, but in essence, where and how that debt was reflected, even though it happened after the balance sheet date, was the first change. And it kind of came up late in the game. Yeah. It was probably into June. Yeah. Until that was even being identified that, oh yeah, we had this April bond issue that we need to disclose differently, because that, we knew it after the fact before the financial statements were issued. Even though 12/31 is the ending period, but because you're in this window until that report's actually issued, you're supposed to somewhat include any relative information post the year end that might have had some sort of an effect on the financial statements. So that's the reason that one came about. And I'll let you talk, not that you're going to say a whole lot, I'll explain the other one on the next page.
Oh, yeah, and yes, the next one, it's all under the same finding number, so it's all kind of collective as these audit adjustments that had occurred. The reconciliation of the transfers between the sewer fund and a fund that's considered part of the remaining fund information or the other governmental funds, how this was accounted for and reconciled was not consistent with sort of the application, the operational side of where this money was going to be, or how this money was reflected within revenues and expenditures versus transfer in and transfer out. So the dollar amount itself is not significant, but how it's reflected within the GAAP financial statements makes an impact. And when you're looking at it as a collective, in order to be able to reconcile transfers in to transfers out, wasn't able to happen on the face of the financial statements with the budget to actual statements and within the notes. So we had to make these corrections so that everything was flowing and properly reflective within the report in total. So as Dean was saying,
I'm sure that all just made a whole lot of sense.
Yeah, I was
gonna put it in layman's terms. This transaction, and you can kind of see here, it's plus 65,000, minus 65, minus, plus, minus, plus, minus. What's the net effect of it? Nothing. Yes. The transaction in and of itself is one thing, but one of the things we struggle with, and I struggle with mightily, is to stay in compliance with technically the way the state, although I think it's archaic, wants to look at inter-fund type of transactions. The Ohio Revised Code regulates, you all are aware that a lot of our revenue streams are restricted in what they can be used for. A lot of our general fund is somewhat discretionary. And there's a lot of things that are in the revised code that talked about if we have a certain fund that's set up and it has a special revenue fund or whatever else, you can't just move money from one fund to another. We can't use money coming in our parks income tax fund to pay for police officers. So, it's pretty rigid how and what flows in and out. Now, money in and out of our general fund is different because that's completely discretionary. And what I tend to use in trying to keep the terminology straightforward when we talk about budgets, not just with city council, but even with staff and administrative staff, is what we refer to as a budgetary transfer is when money, needs to go from one fund to another. Sometimes it has a whole different, not so much meaning, but how it's looked at on our financial statements and what's technically considered a transfer. And even for financial, it's one thing what the ORC wants to look at, but the other thing is even for financial statements purposes. But this actual transfer or this transaction goes back to when we elected to purchase the Public Works site on East William Street. Prior to that, they were at Cherry Street, and they moved. The existing Public Works garage that was at Cherry Street was turned over to the sewer department, and they moved their underground sewer people into that facility. Now, we didn't sell it to the sewer fund, but you're aware our sewer fund is an enterprise fund, and we charge fees to cover our costs. Well, now the sewer fund obtained property that had value that otherwise was a general fund type of asset. So what we did from a budgetary purpose back then is I looked at it over a 15-year period, and we appropriate $65,000 out of the sewer fund to go to, actually it goes to our municipal impact fee fund, because that's what we use to to buy the Public Works facility. So in essence, over 15 years, that sewer fund's gonna pay, with interest, $975,000 for that Public Works acreage that they took over in the building. At the time we looked at that, and it was a fair value and all that sort of stuff. So annually, what I appropriate is a transfer from the sewer fund, in our lingo, to the municipal impact fee fund. So I make sure I get it in the right place, and that pays for some of the debt we issued to do our new Public Works facility. I'm not sure what Rob initially reflected that, probably as a transfer initially on our financial statements.
Actually, yeah.
But whatever it was, at some point, again, I think it's looked at, and you can correct me if I'm wrong, Megan, but you're wanting it to be disclosed not as a transfer in and out of a fund, but more as a charge for a service and expenditure. So they wanted to show it as a revenue in one fund and an expenditure in the other fund, as opposed to transfers, which is looked at differently. So the bottom line doesn't change how we function, doesn't change any issues, it doesn't change, all of a sudden we're missing $65,000 or anything like that.
Correct.
But it's just how it actually shows up. But you can see it's even complicated to follow what changes are made there to kind of get it back to where it should be, so.
Yeah, that's absolutely correct. The net effect of these changes was zero. So, your fund balances, your cash, all that, it didn't change. It's exactly what Dean said. How from an operational standpoint it's looked at versus how a financial statement approach it's looked at.
To keep it simple, not that you have the financial statements, but for an individual fund, on an income type, up here you'll show basically revenues, or charges for service or whatever they are, and then operational expenses. Then below the line is other financing sources, if we borrowed money or something,
Mm-hmm.
or transfers in and out. So in essence, I think the change was, instead of having it below the bottom line, it needed to be moved above it, but again, it doesn't really have any effect on the bottom line or anything like that.
And, as Dean mentioned also, you contract with Julian Group to help in the compilation of the report. So, generally this can be just corrected through, the communication and the monitoring of, what they're compiling. But as also Dean mentioned, the approach to the bond issue side of things was different than, it was an unusual circumstance and something that did happen subsequent to the end of the year and had to almost, again, be looked at again as we were issuing the report. And because of the change, it impacted how it was reported at 12/31/18. So these aren't necessarily consistent type issues. These are just is something that happened during 18 that that was brought up during our audit report process and therefore had to be reported as such within the report.
It shows up as a finding because their role is to come in, and then one of the big issues they do is test our internal control and how much reliance they put on that and whatever else. And sometimes, even though it didn't impact anything from a financial standpoint necessarily, if we're not reporting correctly some transactions, then that's part of what has to be reported in the report.
So, I mean, I guess if you have any other questions on that particular, finding, we can talk about it now. Otherwise, we can move on from there. I don't want to I don't want to miss over anything, but I also don't want to have to, keep talking if it's understood issues. So, I'll just kind of refer back to page 2 in the general. The letter here, as far as, again, disagreements with management, we didn't have any disagreements. That might be, no, that was, yeah. There was no conflict in the approach to how items were reported within your financial statement. That's where that would kind of fall into place. The management representation letter outlines the responsibilities and the disclosures of management, and Dean has signed that. And consultants with other independent accountants, there were none. They didn't go looking to say, okay, Wilson Chan Stowe thinks this way on something, this other firm feels something else, and we're going to go with this other firm's opinion versus Wilson Chan Stowe's opinion. Other audit findings or issues, there was a management letter that we issued, and we'll discuss that in a moment. But there was nothing significant that would fall under the other findings or issues realm. And the other matters were almost as reflective of the verbiage that's within the opinion letter, stating how we look at the RSI schedules, how we look at the MD&A, how we look at some of the supplemental schedules that go along with the CAFR. We don't necessarily issue an opinion on those particular items, but we do say either in relation to the overall financial statements, everything is consistent and reflective, and that's what we look for the most, is consistency and appropriateness in the report and all of the schedules and the findings. So everything ticks and ties and is in order. If you want to look at, I guess, just the general schedule findings, this is part of a single audit report, and it almost just, I like to direct people to that because it provides a nice summary of the results of the audit. The very first box, the type of financial statement opinion was unmodified, which is what you want to see. The next box, there were no material weaknesses, and in controls, again, that's the highest level of deficiency, is a material weakness. And in the next box, you can see, yes, we did have a significant deficiency, and that was the finding that we discussed. Were there any reported material noncompliance? No. Material weaknesses related to your single audit, there were none. Significant deficiencies related to the single audits of your federal programs, there were none. And the type of a compliance opinion that was issued for your single audit was unmodified, which is, again, something that you want to see there. There were also no reportable findings related to the single audit. The major program that we did test was the Highway Planning and Construction Cluster, which is, I believe, consistent when you've had some single audits in the past. I think between that and maybe the airport, are the two that kind of bounce in between what gets tested as a single audit. As a single audit, we look specifically at that program and look at compliance elements related to that program to make sure that everything is in line and appropriate and accurate and complete. So you do qualify as a low-risk auditee for the fact that you have had single audits within the past 2 years. There have been no findings related to the actual single audit, so therefore you qualify as a low-risk auditee. I also included your schedule of expenditures of federal awards, just to kind of outline what the programs were and the dollar amounts involved there. The last portion is your management letter. We had a non-compliance citation. This has been consistently in your management letter, and it just relates to how you operate with your purchase order process. Then on the next page, we have suggestions for improving operations. The first one deals with cell phone allowances. I think you have some different policies and procedures as it relates to cell phones in general. With the way that the payrolls fell at the end of 2018, going into 2019, there was a 27th pay within 2018. And because of that 27th pay, some of the bi-weekly payments went against some of the policies that are out there. Our general recommendation is just to review the policy that you have out there and look to see if you need to realign the verbiage and the policies to make them consistent and with how you want to perform, how you want to operate as a city when it comes to cell phone allowances.
Bottom line is, if you recall, we had at the tail end of the year, we pushed that 27th pay period into
Caused a lot of headaches, didn't it?
2018. What's that?
It caused a lot of headaches, didn't
Well,
it?
it did of sorts for some of our payroll. I think we caught the major ones, like people's health insurance deductions. Our health insurance deductions are a monthly premium. And so had we not adjusted that, they would have paid more than 12 times the monthly premium. This, again, the cell phone, some of our employees get a cell phone allowance in lieu of them, the city buying one. And I'm not even sure what the way the policy reads. I'm sure Megan says whether it says they get a monthly allowance. But if they get a monthly allowance because we didn't adjust that, and it was just so happened that 27th pay period would have otherwise been the first pay period of January, and they would have got their 1/26th of whatever the amount would be. I'm not sure, quite frankly, how they even caught that. It's a small dollar amount, so it amounts to a few dollars. But as far as a change in the policy, I don't know, we could even probably, I guess if I didn't look at it until it just showed up in here, is that, we could have the cell phone policy. It says it's a payment for a 2-week period. That way it doesn't make any difference if in the next 9 or 11 years when we have our next 27 pay period year, it's just paid for every 2 weeks. But anyways, they're just suggesting that we make sure the policy, I don't even know what it reads, to be honest, whether it says monthly or an annual amount or.
There's actually 3 different ways that it reads. Some is bi-weekly, some's monthly, some is monthly paid quarterly.
Well,
Yeah.
Alan Rothamel came up with this about 8 or 10 years ago, so he's in Sunbury. To be quite honest, there was something else that came up months ago, and I thought, gee, has anybody up in the city manager's office even looked at her? Because it's one of those things, how it is, you put it in place and then nobody pays much attention to it for a while. But from a payroll standpoint, they do know that these people, there's like 3 or 4 tiers you can get depending on how much usage you have, business use you have of a cell phone, and anyways.
Absolutely, and this only affected 2 of the tiers, because the 3rd tier it has almost been left in the policy as a discretional amount, and it was generally on, as people wrote it in, was a general amount per bi-weekly versus a monthly amount anyway. So this only really affected tier 1 and tier 2, and I want to say the number of employees may have been around 50 maybe. So it's not like it's a huge issue as far as like the number of people involved, but it is just something, it's just something, a good practice to maybe take this opportunity to look at the policy you have in place, because I think it has been implemented so long ago, and so the policy may not be in line with what the intent or the operational procedures are related to the cell phone allowance and what might make sense for the city.
Well,
So.
the policy works fine just as it is, but the fact that we had a 27 pay period in an unusual format, that we moved it up a day or pay period is really what created the glitch, so.
True, and
Hopefully that
it's
won't
rare,
happen this
yeah.
time.
And then the second piece is the uniform guidance procurement policy. This has been, this is just reflective of there's continuing changes related to the uniform guidance and how they want to classify certain types of expenditures within that contain federal money. So there were some threshold changes that occurred that needed to be implemented within the policies. So I think the city is looking into updating those to be reflective of these different changes. There's really, I mean, there was no impact as far as how, I mean, it didn't impact how money was spent within the federal program itself. It's more of a, just making sure that the policy and the procedures are in line with what the new uniform guidance thresholds were. They actually increased the threshold, so there weren't any conflicting issues with how you actually operate. It just is a matter of verbiage within the policy.
And it's another one of those things, the strings that come attached with accepting, in our case, mostly it's FAA money, because it's federal money. We have to have a single audit act, or audit, and we also have to comply with the uniform guidance and, you know, Davis-Bacon and 6,000 other federal regulations. And so apparently something's changed with their purchasing process, which whatever. But it's just that challenge of somebody who's ever involved in that grant staying on top and amending our policy, I guess, to comply.
That pretty much concludes the summary of the audit and the results of our audit. If you have any questions, I'm available. I know. I guess the general, yeah, I guess the general takeaway.
A little bit different. I don't think we'll get our certificate subject for framing from the state auditor as we have in the past years with no issues because of the accounting thing we talked about with the findings, but there's no real material.
We understand it.
Yeah.
I'll make you up on the computer, you know, back and forth.
All right.
There you go. But no, we appreciate being back at the city. You know, we enjoy working with Dean and Rob and their staff, and everyone's, you know, been helpful in getting us information and working with us. So we appreciate that.
They do a pretty good job, and they're pretty, I mean, nowadays, it's like you don't even see them hardly, at least I don't as much. I know Rob gets to see them a little bit more, but pretty soon it'll be a virtual audit, and we won't even,
Technology.
we'll have something else coming in.
Yeah.
Good deal.
Thank you.
Excellent.
Thank you.
Oh, thank you. Okay. So let's move on to item 4, discussion of the 2020-2024 capital improvement program.
I don't have a whole lot to put in front of you. I know we did get the actual plan as you're used to seeing it out last week. I can just say in general, wasn't as challenging as some of the previous years. It still means we've got strategic issues that we need to consider as we move forward. I want to comment on a couple things and then see if you have any suggestions or requests as we move forward through the CIP discussion with City Council. One of the things that's somewhat connected back, if you look at that capital plan, arguably it doesn't change, it shouldn't change that materially from one year to the next. 2018, obviously we had the whole gas tax thing, and that had an impact on what we're doing. And you should be able to see in the amounts and what's there that as was discussed previously earlier this year, the vast majority of that new gas tax money is going to go into local street maintenance. We also, I know Tom had talked about, and you may see some legislation bumping up our license fee tax. Currently, the permissive amount is $10. I guess they're doing something on our network. So it's going to shut my computer down. And now we have the ability, that was the maximum, to bump that up another $5. So that'll mean a couple $100,000 a year if council adopts that. On top of the new gas tax money, $750. So that's a pretty big shot in the arm for us. A little less than $1 million a year now that's coming in. That funding does have to be spent on road maintenance, and we may have some discussion about that as we go down the road. But it's not like we all of a sudden now we got new money of gas tax money, so we reduced what we were otherwise spending on streets. That isn't a cap. So this is all basically on top of what we were otherwise doing. If you compare this year's plan to last year, you might notice there's a little bit less money on the summary page going into streets, but in the out years, most of that is because a big chunk of what we've had has been related to our share of grant funding for some of the major transportation projects, not just the Point, but the East Central, or East William Street project that was originally going to be mostly grant funding, and then we got a new grant, and then the bids came in at $5 million instead of $4 million, and ultimately it's costing us $600,000. Plus there's they're just getting rolling, now they're still doing some of the final design work with the signalization, big, almost $3 million project. So we had a pretty good chunk of money going to those, the city's share. We don't have as much of that in the out years, so it makes it look like we're not, but it's really that we don't have any really identified grants. One of the things we'll talk about down the road, whether it be with the CIP discussion or just public works or just roads in general, and it kind of came about as we realized finally got Tom to get focused on the strategic side of what we may or may not be looking at down the road, not just resurfacing, but some of these transportation, not just improvements, but major rebuilds, East Central Avenue, a couple of those sort of things that are still rehabilitation. It's not necessarily dealing with building new roads. I tend to think we've got possibilities here that we can find a way to maybe leverage a couple things and perhaps get out there if we can get some substantial grant money. One of the things I know is the case, and as I get people to focus a little bit more on the strategic side, not just the fact that it's a big ticket item, and it's going to cost us $8 or $9 million to completely rebuild and fix East Central Avenue. It's things like, we spend a lot of time out there every year cutting up that road and replacing it. Now, we'll still have to do some of that even if we completely redid the road, but not nearly as much. So as you start looking at where and how that may impact us from a cash flow standpoint, I think there's some possibilities out there. One of the keys, though, is we have to be able to leverage some grant money. If you recall from the levy that we had a couple years ago, we kind of divvied up whatever the annual amount we were going to have, and part of it was set aside to facilitate getting grants. Obviously, we didn't get that, so it's still a little bit of a challenge to get the city's match amount. But to get into that game, we have to actually spend some money even to be able to submit a grant application. And although it's not large dollar amounts, but I hope we'll have some time to talk a little bit about that. Probably going to spend maybe $50,000, $75,000 next year, because you got to get in the line 3 or 4 years out even to get eligible for some of the funding. And but I don't think we want to do that if we don't have a reasonable way to think that we could, if we got the grant, cover the city's portion of it. So at some point we need to do it administratively, because we just kind of get into that mode that all these big numbers and we don't have enough money to do what we need to do, and all the new money was going to be focused on local resurfacing, and but I think there's some possibilities, and I think we just need to kick that around and come up with some ways that we could say, here's where this is at. I mean, we took somewhat of a leap of faith with the Point project and what the city had to put on the table. And I think we're supposed to hear pretty soon whether we got some of the additional safety money. That's a huge issue to us. And if that does, then some of the numbers I've kind of projected out in the last couple of years look a little better. Does that put us in a position that in lieu of less having to go towards our share of the Point, is there a way to look at it East Central? Not that that is the most important rehabilitation, major rehabilitation. I know it's pretty big, and I know I drive down the road enough to know it's right at the front of people's minds. But we'll have that type of discussion. Really not a lot of other changes per se. There is some new issues in there related to actually a bond issue, which we're going to price tomorrow. I previously talked to City Council about City Hall and then improvements, and then the improvements next door. We're no closer than we were a month or two, trying to get somebody focused on what City Hall's renovations are going to look like. But I had an opportunity to tap into the refunding issue that we were going to do related to our previous sewer bond issue. So I had to make a determination to say, do I want to go ahead and lock in long-term rates for the financing of these two projects, along with the computer upgrades we're doing for our ERP system, the police system, and the records management. Interest rates are, they're in a pretty good place right now, so we should do really well tomorrow. But what was occurring is our investment advisors and investment bankers have been after me for over a year. We have a sewer bond issue that was done in 2009. It was for the South Highlands sewer that goes down to Glen Roads. We still owe a little over $12 million on that issue, and the maturity on it was 2034. So we're still 15 years out. But the interest rates on those, if we refinance, in essence, we have the opportunity, because when I issued those bonds, I had a call date of December 1st, 2019, up until January this year, when the federal government and the IRS changed the regulations, but you used to be able to do what was called an advance refunding. Now they won't allow you to do that, meaning you could reissue the debt before the call date. You got to put money in slugs and it was a complicated process. But even while that was still legal, these investment underwriting bankers kept contacting me. Oh, you can save money if you do this, and kept holding off, kind of looking at where the rates are. But ultimately, I didn't do it in advance. We're gonna do a regular refunding. So those bonds are callable this December 1st, and we're gonna actually price the issue, because we can go 90 days out with the pricing. We're gonna price the issue tomorrow, and there'll be an intervening time. But the net present value of the savings, meaning interest cost savings, on that $12.5 million, not in real money, net present values, is $2.9 million is what we're going to be able to save. And just to give you an order of magnitude, back in February, which again, it would have still been, an advance refunding, they were really putting a lot of pressure on me, saying, hey, the net present value savings in February of 2019 was going to be $1.4 million. Wow. So by waiting to now, I can't say it's all crystal ball, whatever else, but we're in a pretty good place. I don't know if you pay much attention to the markets out there, but there's actually an inverted yield curve on Treasury bonds. The 2-year rate, meaning what the federal government has to pay in interest on a 2-year borrowing, is higher than what them doing a 10-year borrowing, which doesn't happen very often. So that's great news for that sewer refunding issue. That'll save us, with what the numbers that are included in the capital plan, it was going to save us about $100,000 a year in debt service to our sewer fund over the next 15 years. Now with the rates, what's happened in the last week and a half since I did that, we're down another 60. We just had a pre-pricing call that I got off on, and it looks like we're going to be another $60,000 if things turn out tomorrow the way they're supposed to. Trump doesn't do anything crazy overnight, so hopefully he doesn't. But the other advantage is with the new money that we're issuing. We're going to issue $2.5 million, and I previously shared with you how that worked with the Cohatch. Our share of not just the Cohatch building, which they're paying rent, $78,000 a year to cover, plus moving planning over there, so that costs us money there that obviously Cohatch isn't going to pay for. And then eventually the renovations to City Hall. So at the end of the day, with using what I could with municipal impact fees, is about $2.5 million. So we're going to go ahead and bond that debt, even though I don't know what the final number is, but we'll be okay from that standpoint. And also the computer software, we're going to spread over a 5-year period. To give you something else to kind of relate it to, that 5-year computer software, we're going to do a 5-year borrowing of $1.5 million. The average yield over a 5-year period, not just 1 year, but over the 5 years, is about, I'd say 1.1%. The current rate of return on overnight investments is 2.4%. So for years, cities used to rely on that as a revenue source because they could get arbitrage yields. They could borrow money because it was tax exempt, turn around and invest it at a higher rate. And a lot of cities there was no real limitations on it. They did it as a revenue source. They go out and borrow $20 million, pay $1 million in interest of that in a given year, and earn $1.5 million in interest. They make money off it. That's what banks do. That's what they're in business to do. The IRS clamped down on that years ago, and then the markets changed, and it was really almost impossible to do because we're very limited in what we can invest our funds in. We're actually, just to say how crazy things are, this isn't just a one night, this is completely liquid investments that I could pull out tomorrow if I wanted to. It's about 2.4%. And like I said, I'm going to pay just a little over 1% for 5 years. So it made sense to go ahead and lock in those rates. The other option I had was just to issue 1-year notes, but the 1-year note rate, I just got it from the the underwriting bankers, is 1.4%. So I'd have paid more just to have the short term and then have to refinance it again. So anyways, those numbers are reflected in there, but I think it's gonna be a little bit more, even a little bit better. The building issue is set as a 15-year borrowing. We're gonna have huge premiums that the investors are going to pay. That'll help reduce our interest costs. So as I originally indicated with some of these building costs to fix them up, in 2023, the money we borrowed to do the streetscape, roughly, I don't know what it is, $240,000, $250,000 a year debt service, that's paid off. So I'll be able to line that up, like I had indicated several months ago when we talked about this with the Finance Committee and Council, to go ahead and expand what work we were going to do and try to complete the work. From a cash flow standpoint, it'll fit in nicely with when that other debt's paid off. So there won't be any impact, so to speak, as far as having to hold back on other capital needs to pay for that. So that'll be a good thing. Other than that, I don't know if anybody had any thoughts. I know George at times come up with things. Feel free, if not tonight, if you'd like to see something. I think our first session to talk about it is September or something.
Well, it's on the agenda
CIP.
for first reading on August 26th, and then we have a work
We have a
session.
work session, yeah.
Scheduled for,
September 12th.
I would say 9th?
It's in the packet
Yeah.
there.
Yeah, I think it's like the 12th or something like
Yeah.
that. If you recall, we did hire, and Tom had made the recommendation, there was a budget analyst, and the person's been involved and been a part of this. A lot of this was just cutting your teeth, kind of getting a little sense how this all worked. But I've got a little bit of a window, can't promise anything, but I really want, because now I've got that capacity and I can kind of work through her. I'm gonna try to see if we can't create some, before that meeting on the 12th, hopefully a week or so before. Because unlike me, I'm a just-in-time person. She's the type of person who likes to get things done in advance. To get some more of a, I hate to call it a user guide, but instead of what you see with a lot of supporting stuff and a lot of tables with numbers, just to kind of break it down, because I can kind of use her newness and the fact that she's somewhat familiar a little bit, but you know, to kind of communicate the information. Can we look at it in terms of what are we really spending our money on? How much are we spending on roads? Is there a way to summarize that differently and talk about some of those related issues? So again, I can't promise, because who knows, there's always things that pop up. But I hope to get something like that, that's more of a narrative with some graphs and some summaries there that show not just what our plan is, and I think we're on the same page with this. I think it's as important to see some historical information, because it gives you some perspective to see how we're allocating our limited resources, where they're going towards, where they had gone to in the past, and that can be as informative as, you know, 3 pages of narrative about a water line project somewhere. So, but we'll see if we
Yeah.
can get that out to you.
Good, yeah, that would be helpful,
Yeah.
absolutely. Anything else on that?
For me.
We'll be speaking about this on Monday. Woo-hoo. All right, so number 5, staff comments. The staff of 1.
None for me.
Okay, 2.
1.5.
1.5. All right, member comments?
I just, real quick, Dean, outstanding job as usual. I appreciate your efforts, great job. And just off on this, with capital improvement, we're talking something, but I was at the pool. At some point, we're gonna have to think about putting money to expanding that pool or something, because, I mean, that pool was built, when was that pool built?
Well, it was originally built in 78, 76, and then it was renovated probably 10 years or so ago, 11 years ago.
It's pretty much doubled since then, so it's just not, you know, but I could see some money at some point in capital improvements to improve that, but that's a
One of the-
Whole nother ballgame.
whole other ballgame.
One of the things that really pushed and an opportunity, because Tom was out with some personal things, and I met with the department heads. We didn't get a lot of, because we didn't have the typical having to really cut things back, but really tried to emphasize with them that the capital plan is not just next year's budget for
Right.
what we want to spend money on. What we lack at times is that looking down the road and anticipating, because that's really what it should be about. Not just to say that, oh, by the way, we might have some major costs, but to start strategizing from a financial planning standpoint, to start thinking about it now. You know, we've had a previous project, you probably haven't paid much attention to it. Years ago, we had an upground reservoir. It was a huge issue. We had it designed we were ready to pull the plug. It was gonna be back then $15 to $20 million, water supply, and if we ever had drought conditions, and it got put on hold for any number of different reasons, but some of the issues that were there are still relevant. And the challenge becomes, even especially with our utilities, to look further down the road. What are some of the demands that are out there? When is that next time? Do we have to expand capacity at the plants or not? Or do we have to do major rework? And ideally, it's not just a 5-year plan that we're looking out here. I can take that information, even though it's foggy the further out you go, but even we can identify those kind of known, at some point, we're gonna have to do something with that swimming pool. And let's think about it now, and let's see what we do today to start anticipating that, especially with our water and sewer utilities, because we've got some reserve balances in there, but what I would like to be able to do is to target that and to say, yes, there may be $8 or $9 million sitting in their reserve balance in our sewer fund, but $4.5 million is targeted because we know out here in 12 years, we're gonna have some major, and I know it sounds logical, but it is a challenge, you know, because God only knows there's a lot of things that come up on a day-to-day basis. That reminds me, one other thing I want to talk on real quick is there was a different category that was included, and I don't want anybody to be too terribly alarmed.
Unanticipated or whatever you
Yeah,
call
and
that.
just to give you a real quick background, because I was talking to Tom, and I was just talking more, even thinking in my own mind about how we plan. You know, Tom's talked about for years, oh, we need to have a financial plan. Well, yeah, I'd love to have a financial plan. We gotta know what we're planning for. If we're not, and I'm not saying that's negative, because we do a pretty good job of staying on top of things, but it's hard to get too far down the road. But one of the things that does come up, even in the short term, is we have a lot of what I call pop-up projects. A lot of them are council generated. They'll bring up an idea, the alleyway over there off West Winter Street, or this issue or that issue. And from a financial planning standpoint, resiliency, I know there's going to be a number of those are gonna come up each year. So we can either look at it and not plan for them to have, I don't know what they're gonna be, or, and then if they come up, say, we'll have to wait till next year to decide, and it may not be something that really, it can be more critical for whatever reason, or to not have to go back and say, well, okay, well, we're gonna rob Peter to pay Paul. So just to kind of get that concept, because I think it feeds into looking at true financial planning and strategic planning and capital planning, and saying, we're gonna carve off enough. It's not like it's this wish list type of thing, but we're trying to be prudent and say we're gonna set aside some funds because you know things are gonna pop up. I think council's confident enough in Tom to say that it's not gonna be something we're not gonna bring back to you before we spend it. But to me, I wanna carve that out, so because what happens during the year, oh, well, do we have any money to do that? And I said, well, we always have money, it just depends on where your priorities are and how you wanna allocate them. So, again, it's just trying to be a little bit more prudent and anticipate some of that,
I think that's great.
so.
Mhm.
That's all I had.
Okay.
Just a couple of things. One more short term. Y'all should have got the letter that I sent out on parking changes.
Mhm.
Regardless of what we decide to do in terms of a lot of that stuff, we've got to replace our parking meters because a lot of them aren't working at all. They're old. They're from the '60s. I'd asked Tom to have staff put together some costs, which they did, but for some reason, I guess he's not comfortable yet with that. But we're gonna have to, it's a 4 or 5 year project to replace those meters. And, it only makes sense, I think, to do them with smart meters.
Absolutely.
Not take coins, but credit cards and
Right.
app, and, you know, it gives us much better ability to manage our parking system. So that's something that we're gonna have to do. A more longer term thought, getting back to Dean's point about thinking years down the road, is we now have Sawmill Parkway with a lot of potential for economic development. It needs infrastructure. There's no water, there's no sewer. And it's easy to say, well, let's wait and let the developers pay for it, but if you look around at communities that are being successful,
Right there.
they're putting the infrastructure in, and so we're not even competitive with the cities, you know, we wanna attract businesses or whatever, they're looking for stuff that's ready, and so.
Turnkey, you know?
Yeah, I think, obviously, we're not gonna do it the next 2 years, but that should be part of that longer term plan, like, yeah, we do want infrastructure down there, how can we figure out a way to start funding that?
Yeah,
Just a couple thoughts.
absolutely. All right. I got nothing. Next meeting?
Kind of maybe leave that a little bit up in the air, whether we get to the next part of, before the operating budget, whether we want to get together and see once if there's some issues before maybe we get focused on that next.
Okay.
Not having a date, but you know, I can see maybe, October maybe sometime or something
Yeah,
like that.
earlier in October.
Right.
Okay. We'll leave that open and just, kinda squiggly line there.
All right.
Okay. All right, seeing how we've met all the agenda items, we can adjourn this meeting. We're adjourned at 4:55.
Thanks, guys.
You wanna buy some tax exempt bonds, talk to your investment.
Thanks for bringing that up.
Delaware